What if I told you that you could pay off your home in just 5 to 7 years without changing your income or lifestyle? Not only could you save hundreds of thousands in interest, but you'll also be setting yourself up for retirement income. Sounds too good to be true, I know. Stick with me and I'll show you exactly how this strategy works. My name is Greg Graham, and I help families secure home loans locally here in Las Vegas. My brother and I work with my father, who has been in the mortgage industry for over 30 years. One of the most exciting programs I've worked with has been around for about 5 years now, and it's already helped hundreds of people across the country become completely debt-free. In this video, we'll break down how this mortgage-free life program works, who it's best for, because it's definitely not for everyone, and the incredible benefits that it has to offer, like paying off your home in just 5 to 7 years, saving a fortune in interest, and even creating a retirement income. Let's dive in. Before explaining how the program works, I want to go over what is required of someone to qualify for this type of loan. I cannot express this enough. Not everyone will qualify for this program. In fact, if you cannot handle your finances in a disciplined manner, we will not recommend this program as a fit for you. Here are the 4 main requirements. You must have a 30 to 40% income gap between your net income and your total expenses. Unlike a regular home loan that considers gross income, this program is based on net income and all expenses, not just what's on your credit report. Without this key component, the program will not work. You must have at least 15% equity in your home. You must have a 680 or above credit score. Overall financial responsibility and discipline are a must. In this section of the video, we will go over how the program works. It's important to go back to the basics and take a look at how an ordinary 30-year fixed amortized loan works. Before you skip ahead though, it's important to visit this point in order to understand the first part of the strategy. We all know that regular 30-year fixtures front-load the interest payments in the beginning part of the mortgage, which in turn only lowers your principal balance by a very little amount. You really only gain equity in the later part of your mortgage. Let's look at an example of something we might see today if you were closing on a new home purchase or refinance. A $400,000 loan amount with a 7% interest rate would give you a regular monthly principal and interest payment of $2,661.21. This is obtained using a simple formula. This is just a calculation that was made to amortize or pay off the loan over the desired term, usually a 30-year term. More importantly, let's go over how the principal and interest portions of your payments are calculated. Loan balance, $400,000, multiplied by your interest rate, 7%, divided by 12 months in the year. Your very first interest payment in month 1 of your mortgage would be $2,333.33. Subtracting this from your regular monthly payment would put your principal reduction in month 1 at $327.88. Congratulations, your mortgage balance is now $399,672.12. I know this is boring, but stick with me here. I want you to see what this looks like month over month. Month 2 would look like this: $399,672.12 multiplied by 7% divided by 12. This would give you an interest payment of $2,331.42 and a principal payment of $329.79. Congratulations, your month-over-month difference going to principal is $1.91. I'm sure at this rate we would pay off your home eventually. With this foundation laid, I want to now explain the first and second part of the mortgage-free life strategy: the sweep account paired with a home equity line of credit. This first and second legs of the stool involve trading in your traditional 30-year fixed amortized loan for a home equity line of credit, more specifically, one that connects with a sweep account. You're probably asking yourself, what is a sweep account? A sweep account is an ordinary checking account that connects directly with your home equity line of credit. I think it's best explained with an example, showing the utility of the sweep account. Our borrower, John Doe, has a $400,000 loan that he has now traded in for a HELOC that is connected to his sweep account. He has a new interest rate of 8%. Yes, this is higher than your regular 30-year fixed loan, and it sounds counterintuitive, but stick with me here. John also has $10,000 a month in net income, but only $5,000 a month in expenses. For simplicity's sake, let's say John gets paid on the first of every month and gets his $10,000 directly deposited into his checking account. Normally, this money would be sitting in his checking account just collecting dust until a bill comes due. Let's put this $10,000 to good use for John. This is where the sweep account comes in. John gets direct deposited the $10,000 on the first of the month into his account, and that very same night, the sweep account automatically sweeps over these funds into his HELOC. This will in turn bring down the balance of his HELOC to $390,000. His checking account will then show a balance of $0. This may seem scary, but the sweep account also works in reverse. Whenever John pays a bill, buys groceries, or pays for anything, he can simply charge his checking account, and whatever funds are needed to cover these expenses will be sent to the checking account from the HELOC at midnight, because the nature of the HELOC is that the funds are accessible and revolving, almost like a credit card. Now, why in the world did we need to send John's $10,000 to the HELOC in the first place? This is a huge piece of the puzzle right here. The HELOC accrues interest on average daily balance. So instead of pushing down the principal of your mortgage once a month, as we did with our previous loan, we are pushing down the principal every single day, thus paying less in interest over that month-long period. Let's try and understand this a bit more. John has paid the $10,000 on the first and sweeps these funds over to the HELOC, bringing down the balance to $390,000. Then on the 15th, let's say John has a credit card bill due for $1,000 and an additional $1,000 for car payments. John's checking account will be charged and subsequently draw from the HELOC to pay for these bills, bringing up his principal balance of his loan to $392,000. Then the rest of John's bills are due on the 25th, totaling $3,000. From then on until John is paid on the 1st, his principal balance on the HELOC would jump up to $395,000. Continuing on to month 2, John's $10,000 deposit would hit on the 1st of the month again and drop his HELOC balance down to $385,000. Bills would hit throughout the month, and after his $5,000 in expenses, the new balance would be $390,000. Rinse and repeat this method until the home is paid off. In truth, the first year of this loan, you will end up paying more in interest simply because the interest rate is higher. After this period, though, things speed up exponentially, not only for the interest paid each month, but the additional $5,000 a month you're using to push down the principal of the loan. A common question we get at this point is, what if I don't want to throw the extra $5,000 I have to my principal every month? What if I have an emergency expense that I need to pay that month? Or what if I would rather throw that money into savings in case I need it later on? A very valid concern, but if you remember, the nature of a HELOC is that it is accessible and revolving. You can make draws from the available equity you have in your HELOC at any time. It's not like a regular mortgage where once you throw money to principal, it's gone. If that's the case, your only option would be to do a cash out refinance and possibly start your whole 30-year mortgage over again. Moving on to the third and final leg of the stool, the IUL life insurance policy. An indexed universal life, or IUL policy, is used to build wealth. Income flows into the sweep account and partly funds the IUL. The IUL returns are based on the performance of the S&P 500 with a 0% floor that guarantees against market losses and a variable upside cap on the gains, providing not only a death benefit but also chronic and critical illness coverage. This gives you a conservative wealth building tool that addresses multiple life scenarios. The IUL is a powerful financial vehicle. In our example, based on the average of 5 to 7 years, we pay off our mortgage-free loan and all other debt. Essentially, the household is debt-free at that time. Next, we continue to build up the IUL. This takes what would otherwise be paid towards mortgage, interest, and payments for 23 years and puts that money toward building a tax-advantaged retirement income. The IUL has another benefit as well, allowing you to take loans against your policy without reducing the account value. It allows you to build your wealth with uninterrupted compounding interest. For example, if you have $100,000 in cash value and take out a $50,000 loan, you still earn interest on the full $100,000. And you aren't taxed on the $50,000 loan. The mortgage-free life strategy combines efficient debt reduction with strategic wealth building. This approach transforms your mortgage payments into a tax-advantaged retirement income stream. It's time to become mortgage-free, become your own bank, and help others. So there you have it, the mortgage-free life strategy in action. By leveraging a HELOC, a sweep account, and an IUL, you're not just paying off your home faster, you're setting yourself up for long-term financial freedom. This strategy isn't for everyone, but for the right person, it can be life-changing. If you meet the qualifications and are ready to take control of your financial future, let's have a conversation. If you have any questions or would like to learn more, click the link below, schedule a call, and we'd love to help you out.